Hi everyone, this is Charandeep Kapoor. In this video, I'll be sharing a strategy with you which makes over 15 to 20% return almost risk-free and with no active management. So this is a kind of strategy which you can just set up and forget, and it will keep on making you money. So in this video, we will cover the explanation of the strategy. We will understand what the strategy is. And this is a strategy which is not new. And this has been taking place in the stock market since a long time and in the crypto market too. So we'll be understanding an example from the stock market. Then we'll be seeing a live trade example in crypto. So I'll be sharing the trade which I've taken and I'll be showing you the returns which I've gotten for that specific trade. We'll also be discussing why this strategy is better in crypto and why it is better in Delta Exchange. And we'll be calculating the returns of this strategy, and I'll be sharing with you how you can calculate the returns on your own end. Also, we'll be hosting a live trading session and a Q&A session on Saturday. So I'll be making a separate video about it. So stay tuned and subscribe to the channel to not miss out on the live stream. So let's start with the video. So guys, the strategy, many of you may have heard of it. It is a basic cash future arbitrage strategy. What is a cash future arbitrage? A cash future arbitrage is a trading strategy which allows traders to profit from the price discrepancy between the cash, which is a spot price, and the futures price of an asset. Here the asset can be a crypto or a stock. So this is a very old strategy and it has been used for a long time in both the stock and crypto markets. So what happens usually is that the futures of an asset or a stock trade at a premium to the spot price or the stock's price. So what a trader can do, you can simply buy the stock and you can sell the future and you can take the profit from the price difference between the both of them. So I'll be showing you a live example in the stock market for this. So let's check it out. So here on my screen, I have the price of the stock of Reliance Industries. And as you can see, the price of Reliance is currently 2462. And if I check out the January futures of Reliance, so the January futures of Reliance are trading at 2486. So as you can see, there is a price difference of approximately 24 to 25 rupees between the spot price of Reliance and its January future price. So if you were to buy this one lot of Reliance shares, and if you were to sell this January future, you would make a profit of this price difference. So whatever the premium which the future is currently trading at, you will make a profit of this price difference between the futures price and the spot price. And this is almost a risk-free strategy in which there is no chance of a risk. So if Reliance goes down by 20 points, the future will also go down by 20 points and the spot will also go down by 20 points and same for above. And at expiry, the price of the January future will converge to the price of the stock. Okay. So you can take the profit from this 24 to 25 rupees price difference. Now 24 to 25 rupees is approximately 1% of the stock price of Reliance. So you can approximately make this profit of 1% in 2 months, that is till 25th January. So you can make a profit of 1% in 2 months, which is an annualized approximately 6% profit, minus the trading fees, of course. And this is a very common strategy which has existed since a long time. And this is what arbitrage type of mutual funds usually do. So there is a specific type of mutual funds which deals primarily in these type of strategies, which are called an arbitrage mutual fund. And you can go and you can check them out. So what the arbitrage mutual fund usually does is that they buy spot stocks and they sell futures against them. Here I have the example of Invesco India Arbitrage Fund Direct Growth. And as you can see, this fund makes an annualized return of 6.81%, employing this very specific strategy. Okay, so now let's check the strategy out in the crypto market. In the crypto market, there is a better version of this strategy available, which is the spot perpetual arbitrage. So in this, we buy the spot assets, that is Ethereum or Bitcoin, and we sell the perpetual future of that asset. Okay. And here, instead of getting a premium, we get paid via the funding rate. What is the funding rate? A funding rate is a payment paid between the shorts and the long, and it is calculated as the difference between the price of the spot and the price of the perpetual and it is paid out over a week's time in 8-hour intervals. Okay, so also let's just discuss the risks about these strategies. So when you are buying the spot and selling the perpetual, you need to make sure that both of your trades occur at the same time. So if let's say you buy the spot here and the price of perpetual at the time of execution of your spot trade was here, but in the time you sell the future, the perpetual's price comes to here. So that can result in a small loss for you. Also, there will be a certain fees associated with selling the future and buying the spot. And also, there is another problem with the spot future arbitrage, which is liquidation. So, in case of a 20% up move, if you are trading at a 5x leverage, your futures position can get liquidated in both the spot crypto markets and also in the stock market. As we took the example of Reliance, you need around 6 lakhs to sell. You need around 6 lakhs to buy one lot of Reliance stock, and you require approximately 1 lakh margin to sell the future against it. But in the futures market in the NSE, you have to maintain a MTM margin along with a maintenance margin for your futures position. So any loss you get on your futures position, you have to settle it at the end of the day. There is a mark to mark settlement. So if you let's say take a loss of 10 rupees against your futures position and a profit of 10 rupees against your spot position, you will have to maintain 10 rupees of extra margin to cover the MTM loss for your futures position. So this is a risk which is associated in the stock market, and to mitigate this risk, you will be required to maintain a large amount of margin, extra cash margin available against your futures position. The mutual funds are able to do it better because they spread this risk over multiple stocks. So one stock future will go up, one stock's future will go down, and net to net, it will be equalized. And also, they will be maintaining a lot of extra cash margin for this. In the crypto market, your futures position will get liquidated at a 20% up move if you are trading at a 5x leverage, and you will need to re-enter into that position immediately. There will not be much loss in this case, only the fees associated with the liquidation and re-entry. It will not cause you a loss, but you will need to re-enter quickly. But in Delta Exchange, there is one specific advantage you get for this. So in Delta Exchange, you can trade the inverse perpetual, which is the ETH USD, and it is margined in ETH and it carries no chance of liquidation. So it is a ETH margin perpetual and your margin is denoted in ETH. So there is no chance of liquidation in it. So in trading this strategy on Delta Exchange, you only have to take care of the execution risk and the fees associated with it. Now, let me show you a live trade which I have taken for this. So what I did for this trade was I bought one Ethereum spot, as you can see in my wallet here, and I sold one ETH margin perpetual against it. Now, at the time of selling, ETH has gone up. So I carry a small loss in my position in the futures and I carry a unrealized profit in the spot market. But apart from that, I have received a lot of funding. Now, where can you check your funding? You need to go to your transaction logs here, and in the transaction logs, you'll be able to see the funding rate. So as you can see, I have received a lot of funding, which is obviously positive, and these are the amounts of funding. And this funding is paid out in ETH. This is not in dollars, this is paid out in ETH. So as you can see, I've received a lot of funding every 1 or 2 hours, and this is direct profit for me because my position is delta neutral. There is no loss for me in ETH going up or down, and I am receiving this funding rate almost for free. Now let's check out how much return I've gotten. So you can download this file from here and you can add up these funding to see how much you have received. So I've done that exactly. And as you can see, I've taken the funding rates which I've received from the 12th of December 2 a.m. UTC or GMT till 11th of December 2 a.m. UTC or GMT. That is one complete 24-hour period or one day exactly. And I've added up all the funding amounts which I've received. So I've received a funding of approximately 0.00043 ETH, which makes it an annualized return of 15.6%. Okay, so I've made approximately 15.6% return from this strategy minus the fees associated with it. Now, what is the fees? Fees of trading a spot is 0.05%, fees of trading a future is 0.05%. So I've approximately paid around 0.1% fees, and if I annualize this return, I have received around 15.6% profit minus the fee, so it is approximately 15.5% return. Okay, so here I've shared the same exact thing which I just told you. If you check out the ETH USD inverse margin perpetual, the symbol for that is ETH USD. Please do not confuse it with ETH USDT, which is a USDT margin future. We have to sell ETH USD, which is the inverse perpetual, and it is ETH margin. Okay. You can check out the funding rate for this perpetual, and as you can see, the funding rate is 0.0283% for every 8 hours. Now, you can calculate this uh, by a simple formula to check out what this rate will be annualized. So as you can see, the simple way to calculate is that if the funding rate was 0.02% in 8 hours, you have to multiply it by 3 to get the funding rate in 1 day, and then multiply it by 365 to get the APY or the annualized rate, which is approximately 21.9%. The fees associated with this trade is 0.05% for selling the future and buying the spot, which makes the total fees around 0.1%. And the total return of the strategy will be 21.8% plus the spread. So if you have bought ETH at a lower price and the perpetual is trading at a premium, you'll also gain from the spread of that strategy. A simple way to calculate is that you can go to Excel or Google Sheets and you can just enter in the 8-hour funding rate, and then you can multiply it by 3 and then multiply it by 365 to get the annualized rate. So as you can see, the current funding rate is approximately 0.0283. So if I enter 0.0283 in the calculator, you can see that the annualized return is currently coming out to be 31% approximately. But this will obviously keep changing for every 8 hours. As you can see, the past funding was 0.0283%, but the next funding is 0.023. So if we enter 0.023, obviously the annualized return will go down, and these are all approximate numbers. So this return, so you should not expect a return of around 26%. That is why I mentioned in the beginning of this video that the returns which you can expect will be approximately between 15 to 20%. And this strategy is best for trading in a bull market, because in a bull market, the perps or the futures trade at a premium to the spot, and you will get the maximum returns for this strategy. And you require no management for this. So if you want more videos like this, please press the like button and let us know in the comments below.